The first breakdown is of a trade that I took on Tuesday during the afternoon session on Nasdaq. I was looking for higher prices on Nasdaq because of the following reasons. First of all, I saw it was a no news Monday because we were in a CPI week, and look at this delivery. This is just a barcode. The market just went sideways and no significant delivery occurred at all. This is the type of delivery that people get chopped up in. This is why I warn you always, and why I tell you to avoid a no news Monday in a CPI week or in any other week where we can anticipate the second half of the week to be more volatile. Mondays like to be used to engineer liquidity on both sides of the marketplace. What we see on Tuesday then is that during the morning session, the market runs up higher and then aggressively distributes lower. This was the low of day. Why was this the low of day on Tuesday likely? And why did I anticipate this run to occur during the afternoon session? Well, first of all, I paid attention to this big down close candle. And what I saw was that this big down close candle, which formed at 10 a.m., took out this low right here. And this candle's low was formed at 10 a.m. as well. So we saw 10 a.m. sell side get purged at 10 a.m. That was a sign to be looking for specific signatures to confirm a potential low of day to me already. When I then saw the market retrace into this CB and I saw a failure to expand lower, that's the right way to describe it. The way that I view the retracements into CBs is the following. I need to see speed and velocity the moment the price retraces into a CB and trades away. If that speed and velocity is not occurring and I instead see discounter rates begin to function as support on price, I can anticipate the market to then reprice higher into at least the high that formed initially inside of that CB. And what's fun is that when I'm breaking down my thoughts and when I'm breaking down my analysis within these lectures, you often notice that I'm trying to make it as easy as understandable to you as possible to look at the markets through my perspective, to my lens. And because this rejection block, the rejection block being from the close of this big down close candle to the wick right here, got respected so perfectly on the hourly chart, we could anticipate during the final hour of the day the market to run onto all of the buy side liquidity that got engineered in this very shallow retracement to lower. These candles are very small, but notice the size of the wicks to the upside. A perfect trend line was being engineered. What do we know when a trend line is engineered? Low resistance liquidity run is likely to occur. But also notice that equal highs were engineered during the morning session relative to the Friday high. If we go into the ES chart, we can see that ES never traded into the close of this down close candle during the afternoon session, whilst Nasdaq did. And that's a warning sign. Why is that a warning sign? Why is this something that should ring alarm bells or make alarm bells go ringing? Well, this is a form of SMT. Nasdaq reached its respective discount array, the rejection block, but ES did not. And that's something to be mindful of. And when you then see SMT inside of this wick, it's even more confirmation of a low likely forming. Here we're on the 1 minute chart and the execution is pretty straightforward. It speaks for itself. And as you can see, the launch cycle created the low of the afternoon session. The market did not trade below the low that formed during the launch cycle. Instead, it traded into this price level, which lines up exactly with that open of this up close candle, which was the low of the launch cycle, meaning there was a failure to displace below this low and take it out. Instead, it functioned as support, but the market also traded into that hourly rejection block at 3:10 p.m. This is, of course, during our time of interest. The market took out the previous cycle low, purged that sell side liquidity, and the market retraced into that after it took out that sell side liquidity. It retraced into this down close candle, which was the previous cycle's low candle, into this CB. So when we see this occur, the moment that price trades above this up close candle, we know a change in state of delivery is occurring. Why? Well, first of all, this down close candle should always act as resistance on price if order flow is going to continue to be bearish. Secondly, because we traded already into the down close candle but failed to displace lower and expand lower with speed and velocity, we can already basically say, well, we have all of this buy side liquidity engineered up here. We have this trend line liquidity engineered. So therefore, we can anticipate that run higher to occur. So the moment that price displaces above this high, or it trades above it, it's just market buy. And that's what I did. I pressed on buy, stop was below the bullish breaker, and there the market expanded higher beautifully. Low resistance liquidity run into the launch buy side liquidity, into the previous cycle's high, and the market eventually ran up higher, but I don't care. Like I said during the weekly review, that you should have watched prior to this review or to this trade breakdown lecture, you knew that during the last week the ranges were likely to be tight, and therefore I was just hanging or aiming for low hanging fruit. Here we are on the next breakdown. And the breakdown of this trade is going to be rather similar to the previous one, because for this breakdown, we're going to first of all take a look at the CPI delivery on Wednesday. Personally, I saw this big down close candle of the ATM candle with the CPI release, and then I immediately was like, I'm not going to look at the remainder of this day. Why not? Because the range of this down close candle was too large. So we can anticipate chop to occur, and that's what we saw. The market went sideways. I know a lot of people got caught up in that delivery as anticipated, and then on Thursday we saw the market open up and run lower immediately into the close of the CPI candle, that ATM candle. We reached that ATM candle at exactly 8 a.m. High impact news occurs, boom, markets get repriced higher. And what's significant is the following. We saw SMT with ES on the lows right here, plus there were failures to displace lower below all of these lows right here, meaning this showcased to us that Nasdaq was strong and that there was a willingness for it to be repriced higher into the CPI buy side and into that old new week opening gap that we've been discussing within our reviews, of course. These were significant reference points. When we then saw this displacement leg higher, I saw the market displace above these highs right here, which set up this run lower. The market traded above the midnight opening price. And when I saw this BC get created, I was looking for a retracement into that BC to then confirm higher prices next into the buy side liquidity above this high right here. Now, what's very important to note is the following. Within all of the lectures of the model series, I've been basically pointing to you the following. Higher time frame expansion followed by a retracement followed by an expansion is a lower time frame market maker buy model. And the lag from this low to this high is what I participated in. And it's more than enough. So if we take a look on the lower time frames a bit, we can see the following. We can see that the market retraced into the low of that hourly BC. Here we can see that 8:30 a.m. news candle. Market reprices higher aggressively. Notice that the low of that BC lines up with the previous cycle high, the high of 7 to 8:30 a.m. During the 3rd a.m. cycle, the market reprices into that high of that 1st a.m. cycle. Look at the reaction of that price level. When you see something like that, you know it's too precise. That right there signals to you that a reversal is likely to take place, especially when you see this type of delivery, where a market just goes sideways and then reprices lower. A market doesn't top like that. It's simple as that. This screams the engineering of buy side liquidity. So therefore, I was anticipating the market to run towards those highs, clear up all of this buy side liquidity. I did not go long yet when the inversion value gap got created. I waited for this high to get displaced above, meaning I waited for this price level right here, which lined up with the high of that hourly CB, or BC I should say, I'm sorry. And then I waited for a retracement into a smaller BC here, and that's where I went wrong. Stop was below this low, and what we can see is the following. We can see that this high was so important because that high formed inside of this CB right here, high, and then the market displaces through that price range, and in that displacement leg there's a small BC here. Notice the closures inside of that price range. This shows algorithmic precision. This shows that high frequency trading algorithms are locked onto this buy side liquidity right here. Went wrong there, stop below here, rode it up higher, rather slow delivery, but notice that every single array that should function as support is functioning as support. Notice that the inversion value gap right here is doing its job. Market taps into it multiple times and it never gives up the ghost. And then finally during the first PM cycle the market reaches that AM high, and then during lunch it even goes above it and expands with the news during the afternoon session. Within Model Series Lecture 11, I discuss probabilities and environment selection more in depth. So I would highly suggest you to take a look at that after this to see why I did not look at the afternoon session and why I did not participate within such a large expansion. Because you need to understand that there are opportunities that present themselves a lot. Every single day there are setups. Every single session there are setups. However, we want to be able to determine which setups are likely to play out and which setups are likely not to play out. But secondly, we also want to know in what environments our setups are likely to play out and in what environments they aren't likely to play out. And once we understand that, we aren't attached to the charts anymore 24/7. We're able to simply say, well, I want to look at these days, these sessions, and those are my days of interest, and those are my sessions of interest. Anything beyond that is then, okay, it's too much. And you need to give yourself permission to say, okay, I don't need to participate every single session. And some of you are experiencing FOMO, some of you are experiencing fear of missing out. And that's a very common issue when you start becoming good at this. And you need to be in control of yourself. You can't let these markets get a hand of you. Simple as that. Now notice that the smart money reversal within this market maker buy model occurred just 1 minute outside of our time of interest of the 30-minute window that I've provided with you. However, you need to understand that the full hour of interest is from 9:30 to 10:30, and therefore this was still a valid smart money reversal. If you go back to the model series and listen to the way that I describe time to you, you can basically hear me say this is a preferred scenario. However, that does not mean that it always has to occur like that. 1 minute off, or 2 minutes off, or 3 minutes off, or 50 minutes off is still very precise. And if you understand that the full window is from 9:30 to 10:30, and that 9:45 to 10:15 is simply a even more precise time window, you're able to really decrease your times of interest for the whole trading day. And that's why this was still a valid smart money reversal to me. And that's why the delivery that followed was still a valid setup to me. And the final third breakdown of this lecture is going to be on a short that I took on Friday on ES. The reason why I took a short on ES was due to the following reason. This was the Telegram message that I shared within the mentorship forum. I shared the following. I was monitoring this for ES at NQ. NQ is of course not visible, but ES is on this chart since that's the mark that we're going to break down. I was leaning lower unless displacement above the annotated inversion value gap this BC on ES occurs and the red box on Nasdaq functions as support on price. I am not a fan of such large overnight ranges for AM trading. So a large overnight range was the following, where we saw the market opened up, form a high during London, and then begin to expand right away. And what I was monitoring was the following. This was our higher time frame sell side liquidity objective that we've been targeting within the reviews. And I saw that it was SMT relative to the CPI buy side between the ES and Nasdaq. When I then saw this BC get overrun, I wanted to see it act as resistance on price, meaning I wanted to see the market retrace, form a high, then continue lower towards that sell side liquidity objective. If we then take a look at the delivery that occurred on Friday, we can see that the market retraced exactly into the high of this candle, into the low of that BC, into the low of that inversion value gap, right here. Notice at that algorithmic precision. Pay close attention. Go into your own charts and see that it's exactly to the tick. Folks, you can't get more precise than that. It's impossible. There's nothing out there that can be more precise than that. It's not buying on selling pressure. It's not like many sellers just stepped in at this price level and then drove the price lower. No. It's programmed to deliver this way. How else could you explain this level of precision? How else? If I'm going to show you in a bit what I'm going to show to you, your mind will be blown because it's exactly what I'm teaching you to look out for. And it's insane how precise it is. And that's what I mean. On these type of days, when the high frequency trading algorithms are locked in on the market that you're looking at, you will see these type of delivery profiles where it's just so precise and you just need to accept it as the reality. The moment you accept this to be the reality and the moment you accept that there's nothing random about these markets, you will begin to see things that you thought to be absolutely crazy. That you would have thought of like, no way that is true. The moment you accept this as your new perception about the markets, trust me, you will begin to see things that are simply insane and words can't describe how you will feel then. So what we see is that the market retraces into that inversion value gap, into this candle's low, immediate rebalance takes place, and the market then expands lower aggressively. I did not trade the afternoon session, so I did not participate in the whole run lower, but again, that doesn't matter. I got 15 handles on ES. That's more than enough. And when you understand that you don't need to capture the full move and that you can just be content with one thing, you can just say, well, let's just live life. Let's do fun stuff. If you want to reach specific trading goals, if you want to reach specific percentage returns, of course, then you need to be locked in and you need to push it. However, when you're just doing enough and when you're just making your ends meet, this is the style of trading that you should adhere to. Not giving you financial advice, of course, but just doing enough, doing something that you can be content with, that you can walk away into the weekend with a good feeling, be happy, instead of trying to force it and taking unrequired risk. What we see is that immediate rebalance on the hourly chart and of course the retracement into the low of that inversion value gap lined up exactly with this down close candle. And if we pay attention to time, we can see the following. We can see that this down close candle was the low of the 7 to 8:30 cycle, which was the first AM cycle, of course. Second AM cycle displaces through that. Where does the market retrace into then? Into the low of that previous cycle, into the low of that hourly candle of 2 candles ago. Immediate rebounds taking place. You look at this reaction right here. Perfect. You can't get more precise than that. At what time? 9:45 to 10:15. SMT with Nasdaq takes place right here. That right there confirmed the sell program to me. So I knew that when the news delivered lower and this placed lower, all I had to do was wait for a retracement. Boom, go short, targeting this sell side liquidity and lower. I was specifically targeting the 5,184 this price level. It was my target. And if we take a close look at the delivery in general, we can see the following. We can see that every single previous cycle's low acted as resistance on price. Not only this down close candle acted as resistance on price, but also this down close candle right here. And what about this candle right here? This up close candle, when it got broken through, didn't it function as resistance on price? Yes, it did. You tell me that right there is not algorithmic. Because you and I both know the answer to that. And if you don't believe me yet, just wait. Just wait a month. Just wait a few months. And you will begin to see. And once you see it, you can't unsee it. It's that simple. And you hear my voice change as well when I'm speaking about this because I get excited when I know that someone is right now listening to my voice over this chart and really experiencing that aha moment, that light bulb moment, that moment of aha, it's beginning to click. And I know exactly what it felt like when I experienced these moments for the first time. And I still experience them with certain things, but when I was developing into the person and trader that I am today, I really cherished those moments. I journaled them. I was like, today I learned about this. Today I learned that new thing. Today I figured this out. And by stacking all of those events, all of those emotions, all of those experiences, in due time, I began building this toolbox of things that I can utilize to get in and out of trades. And that's when you begin to really see the markets for what they are. It's all based on time and price cycles. And if you don't believe me yet, trust me, wait a few months. Please try and prove me wrong. Please try and prove that this is just all buying and selling pressure. Because there's no way that buying and selling pressure can explain these movements that are so precise. It's not possible. Why does this work? Why did this occur yesterday? Or Friday, I should say. Because the market was in a sell program driven towards this high time frame objective that we were targeting within our reviews. That's the reason. So if we zoom in, we can see that SMT took place with Nasdaq here. Market displaced below this BC right here, functioned as an inversion value gap, beautiful. Then the market expanded lower, and the 5,184 was the price level I was targeting. Notice the reaction of that price level when the market retraces to then distribute lower during the lunch cycle. My setup was the following. I saw this bearish order flow. I saw that every single premium ray was functioning as resistance on price. At 10 a.m. we had news. Market displaced below that news. CB formed inside the displacement leg right here. Market retrace into that. Look at these steps into that CB, this institutional order flow entry drill. Market is stepping into that CB, immediately rejecting it. That signals weakness. Market then goes sideways for a bit, retraces into that 5-minute inversion value gap, and here a false breaker setup forms. In my execution video, I had this up close candle annotated. However, you could argue that this is the real false breaker. Doesn't matter because they both formed at exactly the same price range, or in the same price range, I should say. And what we see is that a low forms, high, lower low, higher high. Majority of people would look at this as a change in the state of delivery to anticipate buy-side delivery next. However, what do we know? The drawn liquidity is below market price. The drawn liquidity is lower, and therefore every single discount array that seems to be formed can be utilized as an inverted discount array, meaning as a premium array once broken. That's true support and resistance right there. This is also a breaker pattern. You see a low, high, lower low, high, high. Therefore, this upclose candle should function as resistance on price once broken. And that's what we see. Market displays us below that. I went short the moment that the market retraced into that upclose candle. Stop was above it, rode it lower, targeting the 5,184 price level. Notice that I was able to basically call this expansion leg lower. Why? Because time and price aligned. The right things were occurring at the right time. I should basically word it better. The right things in price were occurring during the right time. Notice that the market traded to this low right here, exactly this candle. If you would take a look at the prices, you would see that they match. Next candle opens up, trades higher, forms a small high right here, and then immediately breaks through it. That CB right here should function as resistance on price right now until the price objective has been reached. And what we can see is that the market reaches that level and it then goes below it, but it fails to expand lower. Within the mentorship form, I shared that I want to see speed and velocity below the 1043 low, below this low, but that did not occur. So that immediately shared with me or told me to likely throw my stop aggressively and get out because I did not want to sit through a deep retracement. This was just a small bread and butter run. So eventually I got out right here and the market in fact consolidated for a bit and then began retracing or began expanding higher slash retracing on a higher time frame and trading above entry. That is of course not preferred, so I'd rather be content with enough than having to sit through all of this. With that, this breakdown lecture comes to an end. I hope that you found it insightful. I probably said too much, but it's all good. I wish you all the best and I look forward to seeing your development. Be safe.